Watch this video before you invest in the lifetime ISA. It might be the difference between making a 50% return or a 500% return on your investment. Hi, my name is Steven. I'm a data insight manager. In simple terms, I manage a team of data analysts. I also have a strong background in finance. If you're new to the channel, welcome to the Investors Circle, a community devoted to personal finance and investing. My goal is to help you make every penny grow. No amount is too little to invest in your financial freedom. If you would like more videos on personal finance and investing, please hit the like and subscribe button to help the channel grow, and then the notification bell to make sure you don't miss any videos. So what's the format? To start with, we'll get into a brief overview on what the lifetime ISA is and how it works. Then we'll get into what you need to know using data and analysis. And then finally, we can summarize and I'll let you know what I will be doing and what I've already done. So what is the lifetime ISA? If you'd like an in-depth definition, you can check out the link below to the UK government website, but here's a quick summary of the key points. Into the lifetime ISA, we can save up to £4,000 each year. On these savings, a 25% bonus is paid into the account. The amount saved and the bonus can be used either towards the purchase of your first home or withdrawn after the age of 60 years. Can anyone open an account? If you're a UK resident aged between 18 and 40 years, you should be able to, and you can save into the account until the age of 50 years. 25% on your savings sounds amazing, but there are some things to consider before you go ahead with the account. The first is that we'll be charged a 25% penalty should we make withdrawals from the account for any other reason than buying a first-time home or before the age of 60 years. This 25% is charged on the account balance, and without going into too much detail, you could get less than you put in. So we have to be sure we use the money we put in for the intended purposes permitted. Also, the savings towards the lifetime ISA contributes towards your tax-free annual ISA limit, which could be a good thing or a bad thing depending on your circumstances. The other things to consider require some interesting data and analysis. Like I said before, if you're planning to buy a property in the short term, a guaranteed 25% on your savings is relatively good because it's guaranteed to a certain extent. I myself plan to purchase a first home last year, and my plans have now been pushed forward to this or the next year. For plans to buy in 6 years or above, a 25% return to me as an investor is pretty poor. But again, it depends on your risk appetite and how educated you are in the investment world. Let's break it down. In this example, we decide to invest £1,000 into our lifetime ISA every year with the aim of using the savings and bonus towards purchasing our first property within the next 10 years. By doing this, we would save a total of £10,000 across the 10 years. Each year, we would be eligible for the 25% bonus, which would be £250 each year and £2,500 across the 10 years. Depending on the account provider, our savings are likely to attract some interest. As little as they may be, this is really useful as the interest could compound each year, meaning it is applied to the current total value. So as the total amount in the account grows, so will the interest generated. In summary, our £10,000 saving would get us £2,500 in bonus and a £562 in interest. This is about a 31% return at the end of year 10, with a total value of £13,062. If you'd like to see the returns from what you would do, this website is really useful. You can enter the amount you would like to save as well as the time frame, and it will give you a year-by-year breakdown of your savings and returns. The link will be shown below. 31% across 10 years is really good considering the low levels of risk because your money is safe. To match this through other types of investments, within the same time frame, they would have to give us a 4.8% annual return. We could get this return from investing in stocks as an example, achieving 4.8% every year with the same 1k annual investment totaling 10k across 10 years would generate the same £3,062 in return as the lifetime ISA, which represents a 31% total return. Let's break it down. As the return is compounding, the 4.8% return is applied both to the annual savings as well as the total current balance of the account. Although the returns are insignificant to start with, they begin to snowball a lot quicker than the lifetime ISA. In year one, we invest £1,000. With a 4.8% return, our investment grows by £48. At the end of the year, we will have £1,048. In year two, we save another £1,000. We achieve the same return of 4.8% on our savings, as well as the current balance of £1,048. So the total return for year two alone is £99. This repeats every year, and in year 10 alone, our return is £600 from our £1,000 investment, as well as the current balance of the account. At the end of year 10, our £10,000 investment is now worth £13,062, which is the same as investing in the lifetime ISA. When comparing the return from the two, you can see the return from the lifetime ISA goes up in a straight line, and it's pretty much the same every year, whereas the amount invested in the stock market is increasing each year through compounding interest of the 4.8%, which is relatively low in return. According to Goldman Sachs, the average return across the last 20 years for the stock market is 9.2%, with the most popular ETF generating even greater returns at 13.6% annually. So how would the lifetime ISA compare with these returns? To be conservative, let's go with the lower number, an average return of 9.2%. with the same £10,000 investment across 10 years. Due to the compounded return from the stock market, at the end of the 10-year period, the return would be more than 2 times in comparison to the lifetime ISA, although it does lag behind for the first 4 years. So why don't more people take the stock market option? The first answer is they haven't seen this video yet. And the other is that there's some risk factors to be considered. The returns in a lifetime ISA is guaranteed and your money will retain its value. Whereas with the stock market, the average return is not guaranteed and your investment may actually be worth less than you put in, depending on the types of stocks you're invested in. The lifetime ISA is relatively low risk, but it's also relatively low returns. Therefore, your choice should depend on your risk appetite. We have discussed investing towards the purchase of a property. Now let's look at saving towards retirement. In this example, let's assume we're 30 years old and we aim to retire at the age of 60 years. We save £1,000 per year until the age of 50, which is the maximum age we can add to the account. At the age of 60, we would have saved 20k into the lifetime ISA, and this would have generated a return of £9,463, which is a 47% return. To match this returns from other forms of investment, they would need to give us an annual return of 1.88%. Comparing the two, the return from an investment giving us 1.8% lags behind the lifetime ISA significantly. Again, the return from the lifetime ISA is very linear, whereas the return from other investment increases each year. I think we can all agree that 1.88% annual return is very low, and the fact that this is the effective returns from the lifetime ISA during a 30-year period makes this a very unattractive investment for the purpose of retirement. Let's compare this to the return from the stock market average annual return of 9.2%. The total return from our 20k saving in the lifetime ISA is £9,463 versus a return of 117,000 from the stock market. This should be an easy decision, but what I guess we should be asking ourselves is what investments generate such returns. As a trader, I am most familiar with the stock market. In my opinion, the best way to achieve such returns is to invest in an ETF or an index fund. These usually hold many stocks and are therefore less volatile. The S&P 500 is an easy choice, but I would suggest doing your research to select the right investment for you. To understand if the lifetime ISA works for you, the chart shows the annual returns required to beat the lifetime ISA returns depending on the year you plan to purchase a property or withdraw at the age of 60. I suggest drawing a line across the amount you believe your other types of investment can achieve. If the bar for your chosen year falls below the line and you're willing to take the risk, go with the investment instead of the lifetime ISA. Now, this is just a YouTuber's opinion. I am not a financial advisor. Please do your own research. So what am I doing? I currently have £8,000 in my lifetime ISA, which has attracted a bonus of £2,000. As my method for buying a property this year does not require me to use my first time buyer benefits, I will either transfer my savings to a stocks and shares lifetime ISA or withdraw the total amount and invest in the stock market, as I believe I can get better returns from investing in growth stocks, ETFs and index funds. I will be sharing the stocks I have or will be investing in. If you don't want to miss the video, then don't forget to hit the like and subscribe button. It'll really help the channel grow. Also, please share the video with friends and family to help them with their personal finance and investing journey. Thanks for watching, have a great day, and I'll see you in the next one.